Lesson 3, the concepts of business mathematics. Welcome to Lesson 3. We'll focus on another set of crucial concepts. Let's structure our analysis framework for this lesson to ensure a comprehensive understanding. Aspect factors. Time value of money, present value. Future value, understanding the concept that money available now is worth more than the same amount in the future due to its potential earning capacity. This concept is known as the time value of money and is a fundamental principle in finance and investing. The time value of money is based on the idea that money can be invested to earn interest or returns, and therefore, a dollar received today is worth more than a dollar received in the future. This is because the money received today can be invested and earn a return, increasing its value over time. For example, let's say I have $100 and can either spend it now or invest it at an annual interest rate of 5%. If you choose to invest it in 1 year's time, you will have $105. However, if you choose to spend it now, you won't have the opportunity to earn any returns on that money. Therefore, the $100 received today is worth more than the $100 received in a year's time, as it has the potential to earn returns. The value of money is also affected by inflation. Inflation reduces the purchasing power of money over time, meaning that the same amount of money will buy less in the future. This further highlights the importance of having money available now, as it is more valuable than the same amount in the future due to inflation. The concept of the time value of money is fundamental in making financial decisions. It allows individuals and businesses to evaluate the potential returns and risks associated with various investment options and make informed decisions. It also helps individuals and businesses to understand the trade-offs between having money now and having more money in the future. In summary, the time value of money is the concept that money available now is worth more than the same amount in the future due to its potential earning capacity. It is an important principle to consider in financial decision-making and highlights the value of having money available in the present. Bonds and stocks valuation yields market analysis. Learning how to evaluate and invest in bonds and stocks, understanding their market dynamics. Bonds and stocks are two of the most common types of investments in the market. Both are issued by companies or government entities as a way to raise capital. However, they differ in their characteristics and performance in the market. In this guide, we will learn how to evaluate and invest in bonds and stocks, and understand their market dynamics. Evaluating bonds. 1. Understand the different types of bonds. Bonds can be classified into various categories such as government bonds, corporate bonds, municipal bonds, high-yield bonds, and more. Each type of bond has its own risks and rewards, and it is essential to understand these differences before investing. Analyze the credit rating. Credit rating agencies such as Standard & Poor's and Moody's provide ratings for bonds based on the creditworthiness of the issuer. The higher the rating, the lower the risk associated with the bond. Consider the bond's term. Bonds can have different maturities ranging from short-term, less than 5 years, to long-term, more than 10 years. Generally, longer-term bonds offer higher interest rates than short-term bonds to compensate for the longer holding period. Evaluate the interest rate. The interest rate, also known as the coupon rate, is the fixed percentage that the bond pays out annually. Higher interest rates mean higher returns but also come with higher risk. Look at the yield to maturity, YTM. The YTM is the estimated total return an investor can expect if they hold the bond until maturity. It takes into account the bond's interest rate, purchase price, and time to maturity. Assess the issuer's financial health. It is crucial to examine the issuer's financial statements and performance before investing in their bond. A financially stable company or government entity is more likely to pay back the bond's principal and interest on time. Investing in bonds. Diversify your bond portfolio. As with any investment, it is essential to diversify your bond portfolio across different issuers, industries, and bond types to reduce risk. Consider bond funds. If you don't have enough capital to invest in multiple individual bonds, you can consider investing in a bond fund. These funds pool money from multiple investors and invest in a variety of bonds, providing diversification and professional management. Monitor your bond portfolio. It is crucial to regularly review and monitor your bond portfolio to ensure that it aligns with your investment goals and risk tolerance. If a bond's credit rating is downgraded or the issuer's financial health deteriorates, it may be time to consider selling the bond. Evaluating stocks. Understand the company's business model. Before investing in a stock, it is essential to understand the company's business model, products, services, and target market. This will help you assess the company's potential for growth and profitability. Analyze the company's financials. Examine the company's financial statements, including its revenue, earnings, debt, and cash flow. A financially healthy company is more likely to provide a steady return on your investment. Look at the company's competitive advantage. A company with a competitive advantage such as strong brand recognition, patents, or economies of scale may have a higher chance of success in the market. Consider the stock's valuation. The stock's price to earnings, PE ratio, is a commonly used metric to evaluate a stock's valuation. A lower PE ratio may indicate an undervalued stock, while a higher PE ratio may suggest an overvalued stock. Analyze the dividend history. Some companies pay dividends to their shareholders, which is a portion of their profits. If you are looking for a regular income stream, consider investing in stocks with a consistent and stable dividend history. Investing in stocks. 1. Diversify your stock portfolio. Similar to bonds, diversifying your stock portfolio can help reduce risk. Consider investing in stocks from different industries, company sizes, and geographical locations. Consider index funds or ETFs. Instead of investing in individual stocks, you can also consider investing in index funds or exchange-traded funds, ETFs, that track a specific market index. These funds provide diversification and can be a good option for beginner investors. Monitor your stock portfolio. Regularly review and monitor your stock portfolio to ensure that it aligns with your investment goals and risk tolerance. Keep an eye on any major changes in the company's financials or industry trends that may affect your investments. Risk and return. Risk types, return measurements. Analyzing the relationship between the expected risk and return of different investment vehicles. In general, there is a positive relationship between risk and return on investment. This means that the higher the expected risk of an investment, the higher the potential return on that investment. However, this relationship can vary depending on the specific type of investment and market conditions. There are several factors that influence the risk and return of an investment, such as the type of asset class, the time horizon of the investment, and the overall market conditions. Asset class. Different asset classes, such as stocks, bonds, and real estate, have varying levels of expected risk and return. Generally, stocks tend to have higher expected returns than bonds, but also come with a higher level of risk. This is because stocks are considered more volatile and can experience significant fluctuations in value. On the other hand, bonds are seen as less risky but also have lower expected returns. Time horizon. The time horizon of an investment also plays a role in the risk and return relationship. Generally, longer time horizons result in higher expected returns as there is more time for the investment to grow. However, longer time horizons also come with a higher level of risk as there is more time for market fluctuations and potential losses. Market conditions. Market conditions can greatly impact the risk and return of different investment vehicles. During periods of economic stability and growth, riskier investments may see higher returns. However, during times of economic instability and market volatility, investors may seek out less risky investments, resulting in lower expected returns. It is important to note that the risk and return relationship is not a guarantee and can vary depending on individual investments. For instance, a specific stock may be considered riskier than others, but may also have higher expected returns due to its unique characteristics. Investors must also consider their own risk tolerance and investment goals when choosing between different investment vehicles. While high-risk investments may offer the potential for higher returns, they also come with a higher risk of potential losses. It is essential to find a balance between risk and return that aligns with one's individual financial goals and comfort level.